Yes. Welcome. Automatic Group, PLC. What is the question saying? Yes, you can hear me now. I hope you can hear me now.
Yes,
Let's
sir.
okay. Let's go to the question. Let's go to the requirement of the question. The question says, prepare the statement of profit or loss and other comprehensive income for the year ended 30th June for the automatic group and the statement of financial position as at that date. The B part of the question, your chief financial officer has asked an explanation why it is necessary to invest time in preparing set of consolidation financial statement as well as those of individual companies of the group. As a training accountant, write a memo to her explaining main advantage of using quality time to prepare the group account. Okay. The B part is theory. The A part say we should prepare statement of profit or loss. Let's assume I'm in exam hall and I'm comfortable with this kind of question. The first thing, I will determine what type of investment do I have automatic as the parents as in the subsidiary, in the investment in manual and investment in Huawei. If you go to the beginning of the question, said automatic, a public listed company in Lagos acquire 80% of manual. Therefore, manual is a subsidiary of automatic. On 1st July 2015, and 25% in Huawei. So Huawei is also an associate because investment that has 25%. Yeah, good. So what is my own duty in exam? It's to Alpha. So with this, I'll now open in the statement of profit or loss, or say consolidated statement of profit or loss and other passive income for the year ended 30th June 2019. Good. So the account is reported in million. So we have revenue, cost of sales, gross profit. After the gross profit, you have distribution cost and admin. Distribution and admin costs. Okay. I will now say share of associate profit, share of associates profit, Share of associate profits, finance costs. Here's the dividend income. And this will give you profit. Before taxation. Now I have my first expense. The profit after tax. Or profit for the period or for the year. Profit for the period. Or for the year, as the case may be. Let me see. Sorry. I'll go and make money. The statement of financial position. Consolidated. Statement of financial position as at 30th June 2019. No current assets. Current assets. You have PP. Can you hear me? Can you hear me?
Yes, sir, we can hear you,
Yes, sir,
sir.
we can hear you, sir.
Yes, sir.
We one plus 920 tangible assets. Sir Roberts?
Yes, I can hear you. Thank you.
Okay. I've not heard your voice, that's why. Equity investments. Two. Then we have investment in associates. In goodwill. Immediately after the goodwill, we go to, we leave to space and go to current assets. Inventories. $520 plus 1.60. Trade receivable. $50 plus 529. Cash. 100 plus 70. Okay. Equities and liabilities. We have the share capital. Share premium. Return. We also have other reserves. Other reserves. Then I'll put my NCI. Then hence, after the NCI, we have no current liability, deferred tax, no current liability, deferred tax, liability, 1,100 plus 250. Current liability, trade, and other payable. And rate is 0 plus 3. Okay, to balance these two in exam, I will start with the statement of financial position. I will do as if I did not see the POL, because if my financial position balances, I'm okay. The POL is just an addition, then adjusted retained earnings of subsidiary as per SYP. Let's check what was in the retained earnings of subsidiary. A29. 29. Combination of net assets of subsidiary items, QA, DOC, and the post-acquisition profits. Then we need to calculate goodwill. We need to calculate goodwill. We need to calculate goodwill. Cost of investment, add NCI, purchase consideration, net asset at the date of acquisition, and goodwill. As well. Then we now go to the retained earning. Return of the parents. Say as per SFP, then in NCI, and in NCI, then investment, NCI, date of acquisition, then investment in associates, investment in associates, at cost, so the bottom. Sorry. Then this is it. Then cost of sales. I'll open account for cost of sales. Let's open one. This is what I will do in the exam. For my course of say because of the this is what I will do in the exam. Okay. Course of say is oh yeah, me as working. Why is it not dark? It's not 3. Okay. Oh, course of 6. Yeah. After this is done, I will now start reading the question and the posting. We'll read and post. We'll read and post. Okay. Automatic is a public listed company based in Lagos. Acquired 80% of Mana Equity shares of 1st July 2015. Oh, I'll go and post. He acquired 1st July 2015. Then he has given me the group structure. What is the group structure? Parent is 80%. Then SCI 20%. Parents 80%. SCI 20%. That is it. When does he acquire? Date of acquisition. Date of acquisition, 1st July 2015. When are we consolidating? 30th June 2019. So this is 4 years. Good. And 25% of four-way equity shares on 1st July 2016. Oh, he also acquired investment in four-way with an associate of both associates. %. Only these two can be 100%. This is another company. Good. When does he acquire the associates? This is for subsidiary. Don't forget, an associate now was acquired when? Date of acquisition. Associate was acquired on 1st of July 2016. 1st of July 2016, a year later, and date of consolidation of 30th June 2019. Okay. This is it. Automatic PSC exercise significant influence in none of the financial and operating policy of Four-Way Limited. So it's an associate. It exercises significant influence. Even though it does not say that, I will assume it's an associate unless it's otherwise stated. Unless it's otherwise stated. The note is on the group already. Since when? Now, investment in manual, four-way, and equity investment we are classified as financial asset through other comprehensive income. Don't forget, we can fair value investments. Our investment can be fair value through profit or loss, or fair value to other comprehensive income. Please, I want you to pay attention to what this grammar is saying so that you can get it once and for all. Okay? Said the investment shown in the individual financial statements of automatic PSC and at cost. This because changes in their respective fair values were insignificant. Good. Let me now explain this. What you have been doing What ICANN has been tested since all these days is because they've not tested when the fair value will change. Let me repeat. What ICANN has been testing this inception of this ICANN exam IFRS base, which is 2014 to date. They have always been testing cost. What do we mean? My brothers and sisters, if I buy investments at 40 million, you know that this, let me open it so that when you are reading, you will not confuse this. I'll cancel that. Okay. Now, let me label this further explanation. Good. Look at it. Let's say you buy investments, 40 million, 4 years ago. This 40 million investment 4 years ago. After 4 years, you see have it in your book at cost 40 million. Do we have it in your book at cost 40 million? After 4 years. After 4 years. No problem. After 4 years, I see have it in my financial statement as 40. It does not make sense. The investment must either increase or decrease. Two things. Either it has increased or it has decreased by fair value. Which is this one is the most important one. This is likelihood. Because if you have investment in order to gain, I will not bad investments. I might done my diligence research to show that this investment is capable. Just like as you want to get married, you do everything possible so that you not get an husband or wife that will impair the family. Now, but we still maintain it at 40 million after 4 years. What happened in case we now fair value? Now say the investment after 4 years, the fair value of the investment is now 90. Is it significant? Yes. I bought it at 40 million. But after 4 years, the value of that investment is 90. They've not tested this. In additional information, they will not tell you the history of the investment that the subsidiary was purchased at a cost of 40 million. We are still going to solve one complete question on this that asks that what I'm saying. The fair value the investment is now 90 million instead of 40. The investment has increased in value. So in our financial statement, individual financial statement is 90 of the parent. 90 I will see, I will not see 40. Let me read that grammar for you again so that you understand. He said the investment is shown in the individual financial statement of automatic at cost. Why does it show it at cost? Say this because changes in their respective fair value were insignificant. Is he maintaining it? If it is significant, what will I do? Am I communicating? Let me first ask before I proceed.
Yes.
Am I communicating? Let me first ask. Now, let's say the fair
Yes.
value, it is now 90. In additional information, you told me the cost of the investment is 40 million. Don't forget when we are doing cost of investment, there's nothing like fair value. You can only acquire you can only acquire subsidiary by cash, by share, by deferred consideration, contingent and loan notes. So fair value is not part of it. So in the exam, and I say, no, they don't fair value subsidiary. They don't fair value, even though you have fair value. You overstate the goodwill by using the fair value amount. Because the goodwill I'm going to calculate is at date of acquisition where you bought it at cost. So first of all, remove the 40, which is stated in additional information for my goodwill calculation. The remaining 50, where do you put it? I will credit investment. If it is fair value through profit or loss, retain earning, debit minus 50. If it's other comprehensive income, that means it's go to other equity components. I will debit minus 50 to eliminate it. Because we don't fair value subsidiary, we only share profit or loss. This has not been tested.
So you are writing it down. You are writing down that fair value.
I will write it off because we don't fair value subsidiary. We only share profit or loss of subsidiary. You only fair value in his own individual financial statement. In the consolidated, I will only consolidate using the cost of investment that you purchase the subsidiary from the initial stage, which is the 40 million. That will go to my goodwill calculation. Don't forget, goodwill must be calculated at the date of acquisition. So the remaining 50 million that you have fair value to the you have debit investment and credit your retained earning. If it is fair value through profit or loss, what will I do? I will not credit investment that you have with 50 million to nail it off and debit retained earning with 50 million. Just
1 second there. If it is, that means the treatment, whether it's fair value, OCI, or fair value, P or L, in the write down.
yes.
Are we writing down both of them to retain earnings? That means it's the same
No,
treatment.
it will tell me the
write down.
policy, just like this question. Yes, it tells me that fair value through other comprehensive income. So in my statement of financial position, I will debit 50. You know, the investment was 40 million initially. The cost of the
Yes.
investment. He has debited 50 million changes, increase in investment to bring it to 90.
Yes.
Investment, debit 50 million. He now go to other comprehensive income. What is the replicate of other comprehensive in the statement of financial position? Other component of equity.
Other components. Okay.
But if it is fair value to profit or loss, that means retain earning. So if it is other components, that means the other equity components has been credited with 50. So if I'm to eliminate it now, I will debit other equity component by 50 and credit investment by 50 if he has fair value. Is that correct?
Yeah, I think that part is clearer for me. Yeah.
Any other person in the class? Oh yes, sort of talk, ask question. This night we are in it to. We don't know when we are going to close it. We must finish this question. We are in it.
Oh,
We must, but be rest assured, based on what they have been doing since all these days, 90% of the question is cost. Just like this question. Just like this one. Yeah, it's putting it at cost. Good. In the absence of no question, let's proceed. So he said he has recorded it at cost, no issue. Good. The details of the reserve and the fair value uplift. The details of the reserves and the fair value uplift transaction as follows. Okay, he has given me what he has at the date of acquisition. So he will not give you the shares. Some portion will give you shares. You just go to the net asset. It's okay. We have 1, the share capital. I'll go to the subsidiary account. What is the share of subsidiary, which is 400? There is a share premium. How much is the share premium? 140. Retained earning as at the date of acquisition, said is 120. Other reserves as at date of acquisition, said is 40. And I say there's fair value uplift at acquisition. The only thing that we can revalue of property, plant, and equipment. So he has told me is uplift, not downward. So revaluation surplus on PPE. 90. Don't forget the second leg. It happens at the date of acquisition. I'll go to the question. The second leg PPE plus 90. So far, so good. This is what he said. This is what he said. Then this just summarize the financial statement of the companies as follows. All figures are going to be correct. Then additional information one now. Automatic incur 10 million direct attributable due diligence costs. Oh, acquisition expenses. Don't forget, all acquisition expenses must not be part of the cost of investment. All acquisition expenses is opposite of your IAS 16. IAS 16 says all direct attributable costs of purchasing the PPE must be capitalized. IFRS say no, all expenses relating to the acquisition must be expensed to the P&L. And I understand, in order not to overstate the goodwill, said all acquisition expenses, just as, for example, if you acquire a subsidiary, another company, you have control of that company, there must be a legal practitioners, the lawyers, that will see that agreement. You are going to pay them. It's an acquisition expenses. Because if you don't acquire subsidiary, you will not incur that cost. There will be a valuer who is going to value all the assets of that subsidiary acquired by you. All the assets acquired by you, there will be a valuer to it. So all these things is what he's saying, that all acquisition expenses must not be part of the cost of investments. They must be expensed to the P&L. But don't forget, all acquisition expenses cannot be of two types. Acquisition expenses not be of two types, issuing costs. Then we have other related expenses. Other related expenses, such as professional fee, such as legal fee, such as due diligence, management time, all those ones, they are other related expenses. But the one that are related to the issue of shares is the issuing cost. The one that are related to the issue of shares is the issuing cost. Which the question will tell you, issuing costs. So for the issuing costs, what is the normal entry for these two? The normal entry. If it is issuing costs, I will debit share premium account. Share premium, I will debit minus. I'll pay the money. Cash will be credited. But if it's other related expenses, Other related expenses, retain any of the parents. I will debit. I will pay the money, cash, credit. But in exam, 90% of the question will post wrongly. Post wrongly. What are they going to do? They will include it as part of the cost of investment. They will say investments, debit. They will add it, cash, credit. This is what the question will do. Majority of the question in exam, this is what they will do. Let me show you. Let's read that part again. Automatic equal 10 million direct attributable costs on acquisition of money. This amount has been included in the current amount of the investment in manual. Just know that 90%, but if they have not posted at all, this is the posting, share premium, debit, cash, credit. Normal entry, if it has not been posted, but have it in back of your mind. 90% of the question, this is what they will do. I will now correct it. What is the correction now? I will now provide correction. The correction I will provide, and I say, okay, correction. Correction depends, is it a share premium, is it issuing cost, or if it is issuing cost, investment now that you have debited, I will now credit. I will now go to share premium account and debit. That's all for the issuing cost. But if it is other related expenses, investments, I'll credit, but the retain earning now. Turn of the parents, the owner of the company, debit. Just like this question. For my goodwill calculation, I'll go to the goodwill calculation. Investment in manual, which is my subsidiary. How much is investment in manual that he has recorded? How much? Investment in manual, 775 minus 10 million.
Minus 10.
Then I'll go to retain any of the parents. Retain any of the parents. Okay, as per SOP, what was the return? We have 1128. I will now say, what is the name of the acquisition expenses? Due diligence. Due diligence cost of 10 million. I will do this. Ask me a question before we proceed. Ask me a question before we proceed. First of all, always know that all acquisition expenses must not be part of the cost of investment. That is what the standard says. Say all acquisition expenses will not be part of the cost of investment. Now, acquisition expenses now is of two types. We have one, issuing costs that are related to the share. They will specifically tell you issuing costs. Then secondly, other related expenses. For the issuing costs, share premium will be debited. Then retain earning. Share premium will be the cash if it has not posted. The other related expenses, our credit cash and debit retain earning. If he has not posted, but I told you, 90% of the question, 90% you post only. 90% of the question. You post wrongly. When we include it in investment. And credit cash. Me, I will not correct it. But my correction depends on where. Is it issuing cost or depends. So that is it. Any question? Any question? That. Any question? Okay, that's any question. Additional information too. The fair value uplift on a subsidiary related to plant and equipment being depreciated to the cost of sales over a remaining useful life of 10 years from the date of acquisition. Okay. The fair value uplift on this associate related to piece of land. The fair value uplift of subsidiary was provisional pending receipt of the final valuation of this asset. Provisional pending receipt of the final valuation. Is provisional pending the receipt of the final valuation. What does IFRS 3 says about that? Let me send it to the platform. Provisional pending receipt of the final valuation. Please go to the platform. Go to your platform and pick it, the information. Provisional pending receipt of the final valuation. What does it say? What does the standard say about it? IFRS 3 business combination. IFRS 3 business combination. I hope you are there. Adjustment to provisional values. IFRS 3, 2008. Permit adjustment to item recognized in the original accounting for a business combination for a maximum period of 1 year. What is this saying? You can only adjust this account but within period of 1 year after the acquisition date, where no information about facts and circumstances exist at acquisition date is obtained. Any sure adjustments are made retrospectively as if those adjustments have been made at acquisition. I don't know the value of this asset. I don't know the fair value of this asset. I'll give it a value. Let me go and value it. The amount I'll still know I will use. Pending, they will bring the results. The result they will bring must be between a year. That's what IFRS 3 says. Now, use of provisional value. If the initial accounting for a business combination is incomplete, by the end of the reporting period in which the combination occurs, the financial statement should be prepared using provisional amount. The amount I know about the asset, I'll still use. Pending, they will bring the results. Amount for the item for which the accounting is incomplete. Measurement period now. The measurement period is the period after the acquisition date during which the acquirer, which is the parent, may adjust the provisional amount recognized for a business combination. The measurement period begins at acquisition date and ends as soon as the acquirer received the information it was taken about the facts and circumstances that exist at acquisition date, unless that more information is not obtained. Now, however, the measurement period cannot exceed 1 year from the date of acquisition. Things to know. How do I know in exam this is what to do? They will tell you. This asset is still awaiting a final valuation. Is provisional pending. That is, you will now apply provisional pending to it. What does it say? It said the asset must be received within 1 year from the date of acquisition. Then I will now adjust it retrospectively. I will now adjust it retrospectively. As if I have known the knowledge as at the date of acquisition. Let's go back to the question. Let me read for you again. What does it say? It says, the fair value uplift in the subsidiary was provisionally pending receipt of the final valuation for this asset. This valuation receives on 1st of January 2016. They receive it. Does it fall within 1 year? When does he acquire? I'll go and check. When does he receive it? Okay. For the pending provisional value, it's okay. Pending provisional valuation. What is the date of acquisition? The date of acquisition, according to the question, we acquire when? 1st of July. 1st of July 2015. So 1 year will end 30th June 2016. This is 1 year. When does it bring the valuation? He said the valuation was brought on 1st of January. 1st of January 2016. Does it still fall within this year? Does it still fall within 1 year stipulated period by IFRS 3?
Yes.
Yes. See, I will now adjust the asset. Does it need to further increase or decrease? I will adjust the asset as if I have known the knowledge as at the date of acquisition. As they tested provisional value before in NICA exam? No. The answer is no. Can they test it? It's part of your syllabus. If you want complete package of IFRS 3 business combination of 2008 reverse, it's about 300 pages. I have it in soft copy. I have it in hard copy. Which one you want? I can get across to you.
We have enough.
I don't want any.
It's like I said, we have enough to read. This your 300 pages.
You can decide.
Don't worry.
I beg.
We'll rely on you to be helping us. 300 additional pages.
Now, the truth of the matter is that we all need it. This is the reason we all need it. You are going to qualify, no doubt, by God's grace. But after qualification, especially I used to tell my people, 3 places are important in this thing we're doing. One, as a financial manager, they are the highest paid in the accounting world. A financial manager is different from an accounting manager. Accounting manager is just debit and credit. The financial manager make decision. That is 1. 2, as an accountant, you need this analysis. Then tax. I don't advise anybody to go to audit. Why? Because in audit, it's just mere waste of time. Because the money has been spent already. And if you try to do any other way, you create enmity for yourself and no money in it. So those three areas are very, very key. And you need the knowledge, current knowledge of everything that is going. Look at the new standard they introduced, IFRS 18. He has changed the reporting phase of statement of profit or loss. So as time goes on, you also need it in your library to consult as you are going. That is it. Any issue? But maybe after your exam, you
Essential
can request for it.
topic.
After your exam, you can request for it, then I will give you. So, and they resulted in a further increase of 10 million in the fair value of the net asset at date of acquisition. This increase does not affect the fair value of non-controlling interest. This increase does not affect. So don't forget, I will not do it retrospectively as if I have not the knowledge as at the date of acquisition. So what do we do now? I will do it retrospectively. How? I will now adjust the net asset. Net asset at date of acquisition. So as further increase of 10. So 100 happen at acquisition. Then I'll go to the 50 plus 10. Then he said the division process.
It's 4 years for the depreciation.
The depreciation. Now be 100 divided by 10 years times DOA to DOC, which is 4 years. So 40. My PP credit minus 40. Then adjusted to any of subsidiary debit minus 40. The cost of sales, we only have depreciation of just a year, not all the 40 years, but just 10 million. Any issue? Okay. Then my cost of sales. Cost of sales of the parents. Let's go to the account. What is the cost of sales of the parents? Two five 2590. Cost of sales of sub 28.
The 40, we have not credited PPE with it.
Depreciation. I think we have done that now.
The 40.
This is it.
Oh, okay, I've not done mine.
Huh?
No, I've not. I hadn't done mine, so I thought you hadn't done yours too.
No. You don't need to write now. I'll send you the position.
It's okay. I've written it now.
Any issue? Cost of sale. Why do we use 10 for cost of sales? It's just an account of a year. So all the 4 years cannot go there. It's just the depreciation of just a year will go to that. But so statement of financial position, the 40. Additional information. 3.
Your screen is not moving. We're not seeing what you're writing.
I have not moved it. Additional information 3 now.
Okay.
Trade receivable of automatic includes 10 million naira and 6 million naira due from manual and forward respectively. While trade and other payables of manual and forward include equivalent amount payable to automatic. You cannot owe each other. You are a single entity. It must be eliminated. Trade receivable. I'll go to the trade payable. Between parent and subsidiary. Between associates and subsidiary, what do I do? Between associate and parents, what do I do? Between associates and parents, what am I going to do?
Associate and parent is a normal sale. It's not consolidated.
Yes. Don't forget, we said parent and associate is only 5 things. Share of profit or loss, dividend paid by associate, unrealized profit on inventory, loan to associate, and impairment. Those are the 5 things IAS 28 give us guideline and how to debit and credit it. Anything other than that, it does not concern you. As we have said, how can we consolidate? We don't consolidate associates. Where is his trade payable? Where do you want me to debit and credit? So it's a pure information, ignore. Because they does not know what they are doing. So any figure they see, they must post. They will post something to just to waste your time in exam. To waste your time. But you know what you are doing, you know what you say, oh, this is associate and parent. What does that say? I should ignore. That's all. That's all. Let's go now. Search for additional information for manual intangible assets include 87 million naira of marketing expenditure. How can intangible assets? Market expenditure is part of intangible assets. The capitalized marketing expenditure. The capitalized marketing expenditure. How? The capitalized marketing expenditure. How? They say include manual intangible assets include 7 million of marketing expenditure incurred during the year 30th June 2019. The director of manual believed that this should be capitalized. How can you capitalize marketing expenditure in line with IAS 38? IAS 38 does not say we should capitalize marketing expenditure. He has given us those conditions, things that needs to be capitalized. So what do I do in this regard is very simple. I need to adjust the intangible assets of the 87 million you incurred in the year. It's not supposed to be part of the what? Intangible assets. So what will I do? Very simple. I'll say intangible assets. 37. Subsidiary is the owner. You have to expense it. I will credit and debit retain any of the subsidiary. I'll say marketing. Marketing expenditure. That's all. What have I done? What have I done? For the intangible assets, I'll see the marketing expenditure is an expenses. I need to be expense in POL. Therefore, I'll say my tangible assets. I'll credit minus 87. Then retain any of subsidiary because the owner of debit minus 87. They intend to capitalize, they've not capitalized. They intend to capitalize, they not capitalized. That's all. That's all. Any question? Any question? Any question? Okay. Let's proceed. Absence of no question. During the year, 4 ways so good to arithmetic. Oh, offering transaction, 4 ways an associate, selling to automatic for 20 million. This good were sold at a markup of cost of 20%. Attached to that, all the automatic still had all these goods in inventory. All the goods is still in the inventory. Associate is the one that sold. Associate is the one that sold to the parent. Okay. Who can tell me the accounting entry if associate is the seller? The total sales is 20 million. And also, he said all the goods still remain unsold. Then there is a markup. How much is the markup? 25%. Who can tell me unrealized profit on inventory? If associate is the seller, 25 over 125 times 20. What does it give us? Happy you people don't sleep. Don't sleep, oh, wake up.
Four.
Don't sleep. Yeah?
4.
Oh, my sister, I've not heard your voices. Section of the class. So forget you have 25%, 0.25 times 4. That will give us 1. So who can tell me how do I pose this one? How do I pose the 1? How do I pose the 1? How do I pose the 1?
The debit retained earnings of the parent and credit consolidated inventory. I don't know.
Okay, thank you, my brother. You are correct. That is the accounting entry. I will debit retain any of the parents and credit consolidated inventory if associate is the seller. If associate is the seller. If associate is the seller. So consolidated inventory, that one, -1 of credits. Then go to the retain any of the parents. I will debit unrealized profits on inventory. I can indicate associates. 1. That is it.
Parent cannot profit itself.
It's part of the group. And well, For absence of no question, I'll go to the next one. What does it say? The next one says, during the year ended 30th June 2019, Mana sold goods to automatic, sold was missing. Mana sold goods to automatic for 1.3 billion. Okay. The company makes a profit of 30% on the selling price. The first intergroup sales must be eliminated from the cost of sales and from the revenue. So I'll go to the revenue. What is the revenue of the parent? I'll go and check. And that of the subsidiary. So that I will eliminate intergroup sales. You cannot sell to each other because you are a single entity. So the revenue of the parents, which is what revenue now, 4480, plus that of the subsidiary 41 minus intergroup sales, total sales for the year. I'll also go to the cost of sales. I'll go to the cost of sales. On the cost of sales, I'll now say intergroup sales. Intra-group sales of 13. Of 13. So, is there any unsold? Let's go further. The question says, the company makes a profit of 30% of the selling price. So that is margin. That is the margin. And 140 million of this goods were held by automatic on 30th June 2019 and 60 million on 30th June 2018. Oh, look at this. They've started again. The unsold, after I've dealt with intergroup sales, the unsold for 2019, also end of 30th June, unsold at 30th June 2019 is 140. So unrealized profit on, don't forget, there is a margin of 30%. Yes, 30% on selling price. So unrealized profit on inventory will now be 30 over 100 times 140. What is the unrealized profit on inventory? So who is the seller? It happens to be manual. What does it give us? Please help with the calculator, please.
So,
hello?
141.
42.
42. 42. So the seller account, which happen to be subsidiary, I will debit his account with 42. Then consolidated inventory will be credited with minus 42. That's all. But he has given me also that goes to the POL. The also that goes to, because he has given me as a 30th June. I'll say, okay. 42 now. Inventory minus 42. Then unrealized profit on inventory will debited to the seller, and subsidiary is the seller. Unrealized profit on inventory 42. Oh, then my cost of sales, marketing expenditure has not even been posted to POL too. I can quickly do that. Unrealized profit on inventory. The cost of sales, okay. unrealized profits on inventory. No, 42 cannot go here. Why? Because he has given me up to 2018. So I'll go to the one that happened within a year. We go to the P or L. So this is as of 2019 on 30th June 2018. So what is the closing? The unsold
60.
The unsold is 60. So the unsold is 60. There's a margin of 30%. Margin of 30%. So unrealized profit on inventory will now equals to 30 over 100 times 60. What does it give us? 30 over 100. 18. So unrealized profit for a year, which is from 1st of July 2018 to 30th June 2019, will now be 42. The closing year minus the closing 18. 42 minus 18, what does it give us? That will give us 24. So not, yes, 24. 24. 24 will go to the P or L, or 140 minus 60 to give me 80. If I do it on the 80, I will still get the same thing by saying 30 over 100 times 80. I think that should give me 24 too. 00, yes, 24. That's all. So it's the 24. Why is he giving me this? To know the one that goes to the P or A. It's the 24 that will now goes to the P or A. It's 24 that goes to the P or A. My cost of sales, I'll now say unrealized profits on inventory. 24. Any issue? Ask me a question. Any issue? Any issue? Immediately they give you for last year and they give you for this year. Know that P or L, they are telling you that the difference within that year must go to the P or L. Must go to the P or L. Mr. Roberts.
Yes, I'm here. I'm not sleeping. No.
Mr. Roberts. Is it clear? Service. My brother, hope is clear. That my sister that used to give me figure and the rest of the class.
It's clear, sir.
Good. Yes. Mr. Robert, I'm still expecting the same type of wine you give me in effort. Some people in this class,
Amen.
they are
Amen.
only inspired by God's grace. Some people in this class, they are saying, oh, you need wine of effort. They refuse to give me my wine. Okay, let's go to the next adjustment. Now adjustment says, annual impairment tests have indicated that impairment losses of 100 million relating to recognized goodwill of Mania including 25% in the current year. Oh, 25% in the current year. But before we do that, don't forget our marketing expenses will be added to the admin expenses during the year. So the marketing expenses, distribution and marketing costs. Let's go to our cost of sales. In order not to forget in totality, the marketing expenses that we have included in intangible, we have removed it. Oh, that's okay. Marketing expenditure. Oh, should go to no cost of sales, should go to admin or distribution, unless the question says otherwise. So the distribution and admin are together. So for that of the parents is 720 plus 290 plus 87. That is that. Then he said impairment of goodwill. Impairment of goodwill, 100 million. But out of the impairment of the goodwill, he has not told me how the value NCI impairments. I first of all credit my goodwill. Then he said out of this impairment, 25% related to the current year. So where does he want me to put the impairment? Is it P, administrative expense, or cost of sales? Let's find out. If it does not say anything, I will take it to administrative expenses, because impairment is more of administrative related issue. The automatic group recognizes impairment loss on goodwill in cost of sales. Okay, but 100 million cannot go to cost of sales. It's only the one in the current year, and it said 25% in the current year. So the 25% of impairments will go to the current year cost of sales. So 25% of 100 for the impairments. When I say impairments, impairment 0.25 times 100, 25 goes to the cost of sales. What it says. Then you need to now go to the next additional information. What does it say? However, on 30 June 2019, impairment of goodwill has revised, and goodwill was now valued at 103 above the original value. The reversal of impairment loss on goodwill has not yet been accounted for. So what do we do?
Same.
What do you say we should do?
I'm saying nothing. That is my thinking. Because is impairment reversed for goodwill? It's not reversed now. Except because what is happening here is that after acquisition, this is internally generated. They now did their own revaluation after acquisition. That's what it seems. I'm just thinking aloud, though.
But thinking aloud, it's not that you are thinking aloud, you are thinking correctly. You are thinking correctly. It's not loud. You are thinking correctly. You are thinking correctly. When goodwill has impaired, it has impaired. No reversal on goodwill. When goodwill has impaired, it has impaired. There's no reversal on goodwill. When it has impaired forever. But for other assets, we can only reverse up to the point of the carry amount as if there was no impairments. Because you cannot make gain from it. That is what IAS 36 says. That if a goodwill has been impaired, you cannot reverse it back. It is gone and gone forever. It was just pulling your leg to see whether students that do not understand that will start doing something. It's purely you ignore because if repayment has happened on goodwill, it has impaired forever. And if you want to know what IAS 36 and IFRS 3 is saying, if you want to know what IAS 36 and is saying, think of a Emefiele. His goodwill has been impaired. His goodwill so it is not okay. Is that clear? Any issue for that? Have you done IAS 36? Have you done IAS 36
Payments.
of an asset? IAS 36.
We're just starting it.
Yeah, we will still tell you. We will still tell you. And we will see some question on reversal of impairment. But for goodwill, when it has been paid, it's here forever. And IAS 36 is correct. If you look at what do you call it, Emefiele, you cannot reverse the goodwill. The goodwill has totally impaired. If you want to look those people that their goodwill has impaired, it's not reversible. You think of Sam Larry. Sam Larry has been impaired. And if you want to talk of the current president, his goodwill is just impaired. But if things continue this way, to the next election, it will shock him. Will shock the man that his goodwill will be written off. Even the Lagos will not be able to control again because people are angry, people are frustrated and agitated. Okay, so he has not told me how to value NCI. Don't forget, NCI can be valued in two ways, and there is implication on it on the payments. If it is fair value, the goodwill belongs to both the parent and NCI, and if it is share proportionate, the goodwill belongs to who? Parent only. And if there is impairment, parent will suffer. If it is fair value, okay. No. So let's go. It is the group policy to value NCI at fair value at the date of acquisition. Oh, he has told me it is fair value. Therefore, the payment of 100 will be suffered between the parent and NCI because it is fair value. Even though I have not gotten the value of the goodwill, I will post that one first where my mark. I will now say impairments. Payments. So the impairment 0.8 times 100, 80, then NCI we also collect impairments. Zero point 2 times 100 to give you 20 as it. Now, when it is fair value, how do I know it is fair value? If you want me to value NCI at fair value, one of these four must be in the question. One, market price per share of subsidiary or NCI will be given. Market price per share of subsidiary or NCI will be given in the question. That's one. Two, fair value of NCI will be given. Three, fair value of the whole subsidiary will be given. Then four, goodwill attributed to NCI. One of these four must be given in the question to indicate to me it is fair value. So let's see which one they give us. Goodwill attributed to NCI amount to 125. So if you're giving me goodwill attributed to NCI, I just need to know my net asset at the date of acquisition and plan. Okay. So let's get our net asset at acquisition. We now have net asset at acquisition. 400 plus 140 plus 120 plus 40 plus 100. What does it give us? Oh, yeah. Can you help us sum this? This is 540.
Excuse me, please. Maybe I'm mixing something. This impairment, 100. I think the impairment value is 200.
No. That is for
The
the associate. And impairment
Okay,
test
that is for the associate.
Impairment of losses of 200 relating investment in 4 ways an associate. It's an associate.
Okay.
But 100 million relating to subsidiary. Additional information 7. Annual impairment tests have indicated that impairment loss of 100 million related to the recognized goodwill of manual, including 25% in the current year.
Okay. Sorry, I was looking at number 9.
We
Number
have not
9.
gotten it. That is associate. Associate
Yeah.
has impaired by 200. So I will debit it any. Let's quickly even do that. For the associates, I say, okay, your investment in associate has impaired, not associate as a whole. So impairment, associates, 200, I will debit, and credit investment in associates, impairment. But subsidiary own, I need to know the net asset at the date of acquisition. What is the net asset at the date of acquisition? 400 plus 140 plus 120 plus 40 plus 100. What does it give us?
800.
800. Good.
840.
Is it 840 or 800? Please let me confirm. 400 plus 140, that will give us 540. Plus 120, that is 660. 660 plus 40, that's 700, is 800. So I will now get fair value of NCI. He has given me goodwill related to NCI. So that will enable me to get, I can now get the fair value of NCI at the date of acquisition. Say fair value of NCI now. Now be goodwill attributed to NCI plus NCI percentage on net assets at date of acquisition. So what is the goodwill? Here is NCI percentage is 0.2 times 800. Then NCI goodwill attributed to NCI is how much? I was given in the question 125. So 0.2 times 125. 0.2 times 800.
160.
0.2 times 800.
160.
160. 160.
Yes.
Make now talk, make you help this thing break. Let's talk, please.
So it's 160.
You are not talking loud. That's the problem.
0.2 times 800 is 160.
No, 0.800. 160.
Confirm, sir. Confirm.
160 plus 125.
285.
85.
285.
285 is the 285 that will not added to the cost of investment. Cost of investment is 765 plus 285. 765 plus 285 plus 765. 10, purchase 1050 minus 800. Minus 800, 250. Then the goodwill will be reported 150. Adios. That's all. So I'll go to the statement of, I'll go to my consolidated financial statement to go and put the goodwill. Goodwill is 150. We have treated in impairments. Other than where indicated profit and loss item are accrue evenly and time basis, that's the end. That's the end of the question. Cannot consolidate now. Cannot consolidate by saying cannot consolidate. Which one now? Minus 40 minus 7 minus 42. 640. 640. Is it 640? I'll bring down 640. 640 minus 120. Minus 120. That is 520. Other reserve. What is the other reserve in the statement of financial position? I'll go and check. Other reserve. Statement of financial position. Other reserve is 70. 70. So this will give me 30. Total post is 550. So SCR will collect. SCR date of acquisition 285, which is the goodwill attributed 150 plus 160. Yes. $125 plus 160.
125.
125. Um, 25 plus 60. I'll not say share of profits now. share profit. We now collect 0.2 times 550. 0.2 times 550. Maybe people used to give me figure. Let me give myself figure. 0.2 times 550. 110. Parents. Share profits. Share profit. 0.8 times 520. And 0.8 times 520. 416. 416. So he has other reserve. I'm going to check the other reserve. What is the other reserve for the parents? Other reserves for the parents. 142. 142 plus share of other reserve. 0.8 times 30. 24. 24. Then associates. So of associate profits. I've not shared that. Associate return is 163 as a date of acquisition. As I just showed up, what is there? Associate as a date of acquisition. I want to share associate profit. And I say share of associates profits. That will not be 163 as a just when you go to return of associate 263 minus 163 or times 0.25. That's 0.25.
Let's check the share of profits. 0.8 times 550. I'm saying 520.
No, I disagree. I disagree with you. I cannot share other reserve here.
Yes.
I cannot share other reserve. I cannot share other reserve in that place possible. Because parent has other reserve accounts. Share profits. Are you getting what I'm saying?
Yeah, I'm trying to. Okay, you added this straight to.
He has other reserve. The total will go to SCI. SCI only has one account. But the parent has other reserve accounts. And he has 142 initially. Out of the 30 other reserve posts, 80% of 3024 goes to the other reserve.
Okay, it's the same. At the end of the day, the effect is the same thing because you have added the 24 straight to
But
the.
if you go and add everything to retain, it will balance the support mark.
There's wrong treatment. Okay.
Yes. Because parent has other reserve accounts where he take his share or post other reserve to that account. If you look at the associate, what is the associate other reserve? 30. Then if you go to the statement of financial position 62, I cannot share other reserve of associates to retain any. I can only share it to investment in associates. I cannot share it to here, retain any. It's not possible. I'll go to investment in associates, share of other reserve. Reserve. So as at SWP, it was 62 minus as at date of acquisition, it was 30 times the percentage of associates. So I'll say 62 minus 30. 62 minus 30, 32 times 0.25, 8. 8 will be here. Then I'll go to the parent as under reserve account. Plus 8. Then associate, what is the cost of the associate? Investment in 4-way, 203. You have not put that. Investment in 4-way, 203. 203. On that note, I can now consolidate. That is the end of this question. On that note, I can now consolidate. That is the end of this question. I can now consolidate. Then I will send plenty question on this type of question to the platform. Apart from the propaganda, let me throw like 3 or 4 more for your practice. Then I send you the solution thereafter. 302 minus 200 plus 25 plus 8, 36. So investment in associate is 36. Investment in associate, 36. Investment as 36. Equity investment, so no changes. 350 minus 87, we have 263. Then PPE, we have 210 plus 920 plus 100 minus 40, 3080. That's all. Then inventory, 520 plus 1460 minus 1 minus 42. We have 1937. 1937. In 950 plus 529 minus 10. 1469. 1469. Then 900 plus 7. 900 plus 7. Then 116. 116. So let's go to the equity. What is the share capital of the parents? I'll go and pay for the statement of the share capital is 1,000. 1,000. Then the share premium is 200. So we need to retain that other reserve. We are through with that 142 plus 84 plus 8. 174. 174. So we still need our retain any and NCI. With this NCI, we have 285 minus 20 plus 110, 375. 375. There any of the parents, we have 1128 minus 10 minus 1 minus 80 minus 200 plus 416 plus 25. I'll give you 1278. 1278. That's all. I'll not take it there. 1278. 12 10 1278. In ACI, what do we get this? 375. 75. No current liability. 1350, 1350. Stream. Yeah. 188. So plus 3 minus 10. 4170. As well, can now consolidate. As a question, you will now go to our POI. Input assets 3080 plus 263 plus 2 plus 86 plus 150 plus 1937 plus 1469 plus 1610 is giving me 8. It's giving me total assets 8547. So let me do the equities and liability. $1,200 plus 1278 plus 174 plus 375 plus 1350 plus 4170 8547. It's fine. Also, so let me go and get my cost of sales so I can finish my POL. Who is in garden? How many people are not slept? And cost of sales. Okay. 590 plus 28 plus 0 plus 10 minus 13 plus 24 plus 25 4189. So 4189 also says 4189 then the revenue 4480 plus 41 minus 13 7289 7280 minus 41 3091 091. The administrative expenses we have 720 plus 290 plus 87 1097 10. The share of associate profits. I will go to the statement of profit or loss of associates. What is the profit of the associates reported? Let's check. Profit for the associates is 148. 148. 148 by 0.25. There is unrealized profit on inventory of 1 minus 1. Any question? 148 times 0.25. This will now give me 36. Finance cost. What is the finance cost of the parents? 50 plus 80, 130. Individual income of 260. What do they say? It's for manual and forward. I will eliminate minus 26. Calculate share profit as it collect dividend. This will now give me profit before tax. What is the profit before tax? 3091 minus 1097 plus 36 minus 130. This will now give me 119. What is the tax? Tax expense of the parents. What is the tax expense of the parent? 330 plus 274. 330 plus 274. That's all. 330 plus 274. 604. No. 296. That's it. Then other comprehensive income. Other comprehensive income. What happened? Let's go to that comprehensive. Gain or revaluation of property. Because gain or revaluation. So gain or revaluation on the gain on revaluation of property. Parents. Parents is how many? 30 subsidiary. 30 plus 37. Then associate also revalue 12. Share of associates other income. 12 minus 4, yes, tax by 0.25. As of associates, 12 minus 4, it times 0.25, that is 2. So, as of evaluation, as on evaluation, different tasks are created as a result of evaluation. Income tax expense related to other comprehensive income, 9 plus 2. Give me 11. So, other comprehensive income now be the comprehensive 37 plus 2 minus 11. 7
28.
minus 11, 28. So a comprehensive income. Now 28. So total comprehensive income now. Total comprehensive income. Now, analysis plus 28. 1324. So I can now share the profits. I say profit attributed. I say profits. Profits attributed to NCI parent. So I'll bring the profit down. What is the profit? 1296. 1296. Good. So how do I get that? Let's go and do that. So profits of subsidiary. Down. I want to get profits attributed. Mo ṣe lẹ́ṣọ̀ lọ́wọ́ máa pè. Mo ṣe lẹ́ṣọ̀ lọ́wọ́ máa pè. Yes. Profit attributed to NCR. Profit of subsidiary. What is the profit of subsidiary? Let's go. Profit of sub. Put here. Yes, 616. 616. There is impairment. It is fair value. But 25 will go there. The one for the current year. There is unrealized profit on inventory. The one that goes to the cost of sales will be peak. Let's check. There is depreciation of a year. Unrealized profit on inventory, 24. Depreciation. The marketing expenses that was not supported. Unrealized profit on inventory, 24. The marketing tradition. Capitalize itself. Then depreciation. Do not start depreciation correctly to be supported from his profits. Any other thing, let's check. As well. So I will now multiply. I will not get everything. What is the profits? $616 minus 25 minus 24 minus 87 minus 10, 470. So I'll now say 20% of 470. I'll get 470 at 0.2. 0.2. 94. So I'll go to the question. Profit 94. 94. NCI is 94. I'll now say 1296 for the parents. 1296. 1296 minus 94. 1202. Then profit and other comprehensive income attributed. Say profits and other comprehensive income attributed to NCI and parents. So I'll go and bring 1324 total comprehensive income. Total comprehensive income 1324. So 94 from profits plus he has revaluation in the question. He has a revaluation subsidiary has a gain or revaluation of 7. Then there's a tax of 2, 5. So out of the 5 is going to collect 20 times 0.2. So now give me his total comprehensive income. 5 times 0.2, that is 1, plus 94, 95. And that's it. 132, that's the end of the question. 132 or minus 95. 132 or minus 95. 20 is 1,229. That's the end of the question. Ladies and gentlemen, ask me a question. Ask me a question. Ask me a question. I want you to go through this. Go through it. If there's any question, you can send to me or chat me on it. Let's discuss. It's a comprehensive question. Maybe in a physical class, if we are solving POL and statement of financial position together, they used to complain that ICANN has tested it twice, POL and statement of financial position together. So, and next week we are going to do fellow subsidiary. We also do SBR formats. We adjust the account for you to see. I'll send you question and